and of the first half of 2021, which is rather extraordinary to think how fast that went. And with it, the oil price. The oil price opens in Asia this morning, little changed, down slightly this week on last. It looks like the markets are paused ahead of the OPEC meeting tomorrow. Let's kick off with Vandana Hari, our regular commentator, founder and CEO of Vanda Insights. Vandana, your thoughts? We saw overnight, again, another significant draw in US oil inventories. We're really making a big bite now into going below the 5-year average, which has to be very supportive to prices. Your outlook this morning?
Hi, good day, Sean. So indeed, we saw successive 2.5-year highs last week. Week closed at 2.5-year highs, and bit of a wobble on Monday. We've seen a pullback, and as you just mentioned, price is a little bit higher today. I think that seems to be mostly in response to the API releasing nearly more than 8 million barrels per day drop in crude, US crude stockpiles data. I think there's, of course, there's a very close watch on OPEC Plus as well. And my personal view is that it might be that, of course, we've seen signals emerge yesterday of perhaps a bit of a tussle ongoing between Saudi Arabia and Russia. And it might be that the market is interpreting that as supportive, if not bullish, because it's obvious that if there is a tussle, then probably it means that Saudi Arabia is trying to impose a sort of a ultra cautious, hawkish tone on tomorrow's meeting. So I think that's what is going on in the markets right now.
Well, let's bring in Ahmed Mehdi, research associate at the Oxford Institute for Energy Studies, sitting in London. Ahmed, just picking up on that point from Vandana regarding the outlook for OPEC Plus. Of course, Iraq, a country you watch closely, has over the last year and for quite a long period been one of those laggards in complying with quotas. Now they are complying. There's a risk here, isn't there, as OPEC sits down, to really maintain their credibility. They do have to put a reasonable increase of supply in the market in order to maintain discipline and credibility. Your thoughts ahead of the OPEC meeting?
Good morning, Sean. Yeah, I think that just to echo Vandana on, just to take a step back for a moment, just looking at what the price signals are telling us, so not only with flat price, but also with the time spreads across all the key benchmarks. They're in, they're very much backwardated, and sending a signal that OPEC Plus has room to increase supply. Likewise, another interesting dynamic that's perhaps completely flipped on its head since last year has been the relationship between Brent and Dubai, which in fact we're seeing that spread also beginning to widen as well, and that limits the amount of Brent-linked cargoes moving into Asia. So actually, in an interesting way, we're sort of moving into a situation where each region is sort of trading its own supply at the moment, and that's also being reflected in the prices for basically a good way to tell how the market is doing. The sort of thermometer of the market is by looking at West African flows as well, and differentials for key West African barrels, which are improving. Now, there's a very big difference. The banks, typically the big investment banks, have very, in my view, sometimes slightly outlandish views on what the current deficit is in the market. Some suggest between 2 to 3 million, which is not really necessarily accurate, because whilst we're seeing some crude draw, significant crude draws, we also have some product builds as well. But nevertheless, there is definitely room for OPEC Plus to increase in this meeting ahead. For me, I don't think it's necessarily...
The question on that is, from the point of view of increase, clearly everybody would be in consensus with that at this point. They've held the line for a while, but this idea of a moderate increase, where do you fall on that, and how big is moderate, do you think?
So I think basically a reasonable, based upon balances is that August you see if there's no action at all from OPEC Plus, then the deficit widens out to about between 1 to 1.5 million barrels a day, just given what runs are looking like and what the demand expectations are. So I think the Q3, Q4 demand estimates, there is obviously a lot of optimism around demand as well, and you can question that if you like, but nevertheless you're still seeing that beginning to build throughout the next 2 quarters. However, I think that the current consensus around 500,000 seems reasonable. The question I don't think is necessarily about the volume, but more the duration and the signaling and the messaging around that. The fact that they're meeting on a monthly basis, and the fact that I think the actual difference between Saudi and Russia is perhaps more on the US shale, in terms of how quickly that comes back, given the fact that rigs are being added at a slower pace compared to previous recoveries. And, there's perhaps a difference on what capital discipline means for both camps. But in saying all of that, I think that, typically in previous cycles, it's often been the issue of what is the marginal cost of production, and it's obviously below $65 or $60 even. So in this case, the fact that the US is not coming back as quickly, they have some room. But as I said earlier, the fact that they meet on a monthly basis, for me, the interesting thing will be what kind of guidance they give, not necessarily
the sort of central bank thesis of forward guidance. Let's bring in Chris Wood, CEO of Savanara DMCC, located in Dubai. Chris, what are the challenges? While in some ways the supply challenge or complication has been taken off the market, clearly Iran is not coming back anytime soon. Shale, for whatever multiple reasons, seems to be parked on the sidelines. So there seems to be a clear pathway on supply, but now demand might be tricky. Second variant or whatever, third variant in Europe, and China looking like it's certainly not growing to the extent that it was. We saw overnight PMI numbers a little bit soft, dropping. China's official manufacturing PMI for June fell to 50.9 from 51. I mean, not a massive decline, but nonetheless not increasing. Your thoughts on where China's at in this demand outlook?
Morning, Sean. Morning, everyone. I think the OPEC team have got an interesting conundrum ahead of them of what they do, because as you rightly pointed out, there are a couple of things that they need to be considering. One is the COVID variant, what's happening with that. It's very uncertain. It seems to be all the press you read and all the information you hear about it is saying it's quite aggressive, more aggressive than what we've had before. And is that going to then spark new waves around the world as people's global mobility starts to improve, people start to travel again? The second one is, as you rightly mentioned, China. If you look at the URSA data, China's sitting on a shed load of storage of oil, which is built up over the past few years. Yes, it's down on pre-COVID, but it's up on this year of, I think, around 24 million barrels in its storage. And it's signaled quite clearly to its own producers, look, its own refining community, look, we're going to start hauling back on some of the import quotas coming out into the country, which particularly for the teapot refineries. And also at the same time, they're opening the gates a little, or even more than a little, on exporting fuel oils and other products, which is then going to depress refinery capacity in the rest of the world. So there's that sort of, okay, demand side, it's picking up, but is it really picking up? Is it going to pick up to the level we want in August between the COVID and where China's at? Shale oil, those guys, they haven't been sitting on their hands waiting for something, and that those guys have been very busy. You've got Pioneer, who's been acquiring acreage and new licenses. And if you remember, the US was very much holding back when Biden came in. He's paused all granting of some permits. That's now opened up. New permits are being acquired. So Shale has been working on three key things. One is getting more acreage for the key players. Second is improving techniques. And the third one is capital discipline. So what I mean by capital discipline is they're tapping in DUC wells, so drilled but uncompleted wells, and getting the most value out of that, which means there's less capital intensive process of extracting shale. Doesn't mean shale's going up in overall capacity, but they're getting ready for what's coming. And then if the forward price starts to support their economics and being able to lock in versus differential on the forward oil prices, then they'll be able to drive forward. So OPEC are in a very interesting position right now.
Yeah, Vandana, you'd have to say OPEC plus, OPEC, Saudi Arabia have probably never, well, not never, but certainly a long time since they've been this strong a position where they can, control, or they've shown great discipline, and they are now very much in the driving seat with the higher cost oil producers, for whatever multitude of reasons, still on the sidelines. What's your assessment on their appetite to draw down inventories? We're now clearly below the 5-year average by most secondary source assessments. They could really take a big, deep bite into inventories. What do you think their thoughts are on that? What would your guidance be? Because that could really strengthen prices over the midterm.
Yeah, so when the OPEC committee last met before the last ministerial meeting a month ago, if I remember, the committee's projection was that global OECD oil inventories would be drawn down to the 2015 to 19 average levels, which is what OPEC Plus has targeted, by the end of July. And then after that, we had the IEA monthly report come out, which said that that's already happened as of the end of April. So let's assume the truth lies somewhere in between. So, I think one can safely say that that target, OPEC plus target, which was already, much more, shall we say, hawkish than by removing 2020 from that account, has already been met.
I mean, it sticks in my mind that comment a few months ago, if you remember, Prince Abdulaziz, when asked about, India's in pain at these higher prices, and that was in the low 60s at the time. He said, well, if they're in pain with the high prices, let them draw down some of those low-priced inventories they bought last year. So maybe he has his eye on that.
That, and there's been some other rhetoric, not so open. I see quite a bit of it on social media from other Arab producer members that, well, if Indian consumers are feeling the pump at the pain, the pain at the pump, sorry.
It's so painful, it's pumping.
It's all pain and pain. Why doesn't the government reduce the taxes? They tend
the old
to
chestnut.
But going back to your question, I think it's really interesting. I completely agree that OPEC, in OPEC's history, and certainly in OPEC Plus's history, I think they haven't been as strong before as they are now, because as Chris was mentioning, shale is very, very subdued. It's not expected to come back in a meaningful way, at least this year, perhaps next year. So the question now really is that the 2015-2019 inventory target is of their own making, right? They can decide to put it aside. So the question now is, what do they do with this newfound power that they have on the market? And again, as I mentioned earlier, I feel, and again, Saudi Arabia played that trump card, surprised everyone in the market by saying we'll cut an additional 1 million barrels per day voluntarily. And I think that has given Saudi Arabia an upper hand. Until then, it was pretty much, Russia and Saudi Arabia sort of evenly.
But that is now, that 1 million is, as of the end of July, according to their plan at least, will be gone.
Yes, but I think that still has given them a sort of a new moral authority, if you will, to impose a more cautious, conservative view and on OPEC Plus. So, to my mind, I was wondering, it's very interesting, the news overnight that the JMMC has been postponed by a day. So I presume that means for the Saudis and the Russians to find a common meeting point. And I was wondering, what could this possibly mean? Look, but I don't think it's no increase. I think that would be pretty unimaginable, even given OPEC Plus's predilection for surprises. But it could be between the tussle could be between 500,000. Increase and perhaps a bigger increase if that's what Russia had wanted to come to the table with. So it'll be interesting to see what they finally do. My base case is still at least 500,000 barrels per day of increase.
Ahmed, what are your thoughts on where is Iran in all of this? I think, like OPEC Plus, we're all surprised, perhaps, or had expected that the Iran-US, the nuclear talks with the permanent 5 members of the UN Security Council were all moving in a very positive direction. That now looks not to be the case. What do you think the impact of that is, and the outlook, indeed, for those talks to still deliver a deal?
So I think that going back, just a step back for a minute, the decision making for OPEC Plus I think partly it's also going to be related to Iran to a certain extent, but not as much.
As it would have been, given if the deal had been done, right?
Yeah, I think there's a couple of points on Iran. One is, firstly, I think Chris mentioned it earlier in terms of what's happening with the clampdown on the quota trading by independents, and they were typically involved in procurement in the first quarter, and that's why you saw that uptick in Chinese purchases. And obviously now there's a bit of a clampdown going on, but that doesn't actually, in my view, and others may differ on that, impact runs in China, because it's more of a leveling of the playing field. So it's actually the state-owned refiners will make up for those runs. So I still see Chinese runs actually proving quite healthy into the second half of the year. In terms of Iran itself, I think that one interesting parallel that has been drawn out is comparing it to 2018, when Trump pulled out, and then the Saudis were wrong-footed on the waivers, and after having increased the quotas by about 1 million barrels, and then there was that sort of U-turn, and there was waivers provided to a number of buyers. I think this time round there's a couple of differences on what the return of Iran looks like. One is to do with pre-sanctions, European refiners were purchasing around about 700,000 to 800,000 barrels a day. I think this time, with regards to European banks who are providing financing for term purchases, they're a lot more conservative, more difficult. So there's logistical bottlenecks around procuring Iranian cargoes. Also, there's also a greater availability of feedstocks for European refiners compared to the past, with blending processes with US crude and Kirkuk volumes.
I mean, it does feel in that way that there isn't a tremendous amount, whatever urgency the new Biden administration had sort of brought, from being a new administration, to the resolution of the Iran deal, that seems to be dissipating, and no one else is really sort of saying, oh, this is a massive problem that needs to be fixed, and so let's corral the whole world into a major diplomatic agreement. I think there's just some essence of necessity absent. Chris, just coming back to the outlook for the US, the dollar has gained a little bit, bringing a bit of strength to the market, which of course makes commodities and oil a bit more expensive. But we have the outlook for the US jobs data. And while China might be sort of plateauing a little bit at the moment, the US seems to be roaring ahead.
Yeah, it does seem to be that way, that the US is getting back. You've got to remember also the stimulus packages that people received are dwindling. The money in the bank accounts, their real spending capacity is dropping. So they need to get back to work, get jobs. You hear of it in Europe and America, where companies are struggling to get some of the labor force back.
We have the US jobs data coming out this week as well, which will be another big signal for the market.
Indeed. And I think even Oxford recently released some reports around the spending on the US market, where you're seeing durables fall a bit. Now the question is, the durables spending falling, is that due to money running out, or is that due to supply chain constraints? I haven't been able to look at that as much. But you're also seeing an increase in services, where people at home are starting to buy more services and focus on that, which then implies that is people coming back into the workforce, and you are going to see an uptick in employment, which is a good sign, a good recovery. It's what the US market desperately needs, what the world market desperately needs.
I suppose, then what does the Fed do about it with all of this sort of tapering noise? Let's get this survey question and then have the panel. I'd like the panel to give us their sort of half-year thoughts, 6 months, the first half of 21, and the second half being apparently the big recovery when all demand comes back. So we get their half and half views. But first, a survey question. Should OPEC Plus announce a new supply plan for 1 month, for 2 months, for 3 months? As Ahmed, I think, said earlier, it'll be most interesting to see what the noise is around rather than the amount that they sign up, or remove all limits altogether. Maybe that's the surprise this time. Quotas are over. But welcome your thoughts. Should OPEC announce a new supply plan for 1, 2, or 3 months? And let's get our thoughts. Vandana, it says we started the last month of June, the last trading month of the first half of the year. What's your kind of big takeaway surprise from the first half, and what's your major I'm looking at for the second half?
Yeah, interesting. So I think my biggest takeaway is also my biggest surprise, which is that it was always expected that this would be a year of two halves. I think that's how it was being perceived since the latter half of last year, given the expected pace of vaccinations and everything. But the more I look at that graph, if you do a consensus of demand expectations for the first half of the year and the second half of the year, it's gone really, really steep. If you look at what the OPEC committee said yesterday, 6 million barrels per day expected year-on-year increase in demand, 5 million of which is going to come in the second half of the year. I can't certainly in my memory think of a more steep incline in terms of demand or two halves of a year. I think that is going to be quite a challenge for OPEC Plus to navigate.
Do you think there's a lot of that built into the price, Vandana, that this second half is coming, or that's yet to be built into the price?
Oh, no, completely. I think it's all been factored in, which is why a lot of people, I certainly like to talk about draw market attention to the downside risk of this. It's going to be all honey and roses in the second half of the year sort of perspective. I think a little bit of balancing is needed, especially as we talked about the threat of the variants. My second big surprise has been, of course, as I mentioned earlier, Saudi Arabia it was, the way I saw it, a very even balance of power between a hawkish Saudi and Arabia and a slightly dovish Russia ever since 2017 when they came together as non-OPEC. But I think definitely the way I see it, Saudi Arabia is back in the driver's seat. Just because of that, and you quite rightly, as you say, that 1 million barrels per day is being returned to the market. It may not ever happen again, but just that ability of Saudi Arabia to do that. You all can stand in one corner. We are on our own, going to tighten the market if we feel like it. I think that for me, that sets a tone of perhaps, there will be more hawkishness than dovishness going forward. But nonetheless, I think Saudi Arabia is feeling the pressure of inflation. We heard the minister talk about it a week or two ago, a nod to the inflationary pressure being added by high oil prices. So all said and done, on balance, I do expect them to be opening the taps a little bit more in the second half of this year, especially if, they themselves are saying that the second half demand growth is going to be so much bigger than the first half.
Ahmed, your thoughts again, similarly, first half takeaways, second half outlook. And I'd also welcome your insights on the Iraq electricity crisis within, although it's different, but a comment on that.
I think the interesting developments have been effectively, if we look in the beginning, I think that with regards to how Saudi has navigated and steered the market, I wouldn't necessarily suggest that the 1 million cut was, I mean, basically the way to frame the 1 million cut was effectively, I think at the time it was around their own difference of opinion around what the demand outlook might be. So being a bit more cautious, and effectively the flexibility of OPEC Plus has been quite interesting to watch this year. And actually, there's been a number of commentators who have perhaps been wrong-footed on the idea that this will break up, that there's differences. You remember back then there was a lot of discussion about the UAE wanting to pull out, and in fact none of that has transpired. In fact, what we've seen is compliance has been relatively strong despite a couple of hiccups. And even though
do you have any indication not to maintain confidence for that in the second half? I mean, there is sort of rumblings that cheating could come in, and then the credibility.
I think in previous cycles, typically there's been a couple of whiteboard assumptions around OPEC behavior. One of them has been rising flat prices equals loosening compliance, and
yes,
we've seen some cases of that, but realistically overall compliance has been strong, largely I think because of this new way of managing the OPEC behavior through each month, and also this compensation cuts. Whilst it hasn't actually happened, it actually provides a signal to at least meet your original quota Lastly, I think that Iran has not really, the expectations around Iran have not really transpired. I think going forward, I think that actually the reason why this meeting is interesting for me is not necessarily, as I said, it's a no-brainer that you would release 500,000 barrels. You can do it. It's not going to impact on flat price structure. But I think the interesting question is into next year. I think that's where you get a bit less certainty around where the, on price direction and where the market is, because I think even in this comment box, someone correctly says, you've got to look at refining margins, which are still under pressure. You've still got to look at where the product stocks are looking like. And finally, as Chris said earlier, is that US is not dead. Next year we're going to see a significant return of the US, just simply because a lot of these budgets for this year were already set, but now you've got WTI creeping up. Next year, I think you're going to get a bigger surprise on the upside. And Iran, there's a bit more certainty on their return. So that's why what guidance and what policy instrument OPEC uses for next year, that's a more strategically important question than, realistically, how much will they increase or not?
Well, maybe it's another 20-minute meeting and there's nothing other than we'll see you next month. Let's get the survey question, give Chris the last word. So the majority of this room thinks 3 months forward guidance is the best idea. Chris, I'm sort of caught between two surprises of the first half. Welcome your thoughts. Is the US shale discipline for not jumping in more impressive than the OPEC discipline of holding the line? It seems to me it nearly looks choreographed in the way that the OPEC plus one is choreographed. The US obviously is not legal to do so, but it certainly is so disciplined. It's my biggest surprise of the first half of the year. Your thoughts?
Yeah, it is interesting to watch the US shale and watch where it's going. I think there's two things there. One is the ESG debate, and that's been the biggest surprise for me this year, is how firmly corporates have had to deal with that this year. I remember sitting at the IP Week dinner, when was that, 2020, with yourself, and you had Bernard Looney talking about where BP was going to go, and you could hear the room going, what? Is this guy actually in the right room? And here we are a year later, and you've got the big oil majors having to comply because of shareholder pressure. So that's been a very interesting on how this whole ESG debate has pushed to the fore and the impact that's going to have in the years to come. On the shale side of things, as I said earlier, I think there's a lot more discipline. It's like every gold rush. Every man and his dog comes in the beginning and prospects for every little bit of opportunities. Now you've got the majors in there, you've got the premiers, the others in there that have a good track record, who've got capital discipline. And I think that's where you're going to see shale go now, is the consolidation that we're expecting the back end of last year is happening. And you will see a more controlled rolling out of shale capacity. But at the same time, there's a lot of CapEx sitting there that's just waiting to be deployed and new wells to be drilled. So I agree, I think you'll see shale come back with not a vengeance, but with a modest increase over the back half of this year and certainly into next year.
Well, that's a wrap. I mean, my biggest surprise of the first half is what I just said, that the shale and other higher cost producers not coming back at these prices. My second half of the year, I think, is going to be the European summer is not coming. I think that's what's transpiring now, that whatever aviation volumes were going to be consumed with Europeans traveling to their holiday destinations is looking increasingly very doubtful for with all of these restrictions coming back in due to the Delta variant. So I think you have going to be not quite that second half of the year demand recovery that is forecast. To what extent built into the price, we're going to wait and see. But of course, tomorrow is the big OPEC decision, and that'll be dictating everything in the immediate term, and we'll wait to see what happens there. But thank you, Ahmed in London, Vandana in Singapore, and Chris in Dubai. Really appreciate your insights this morning. For those who are interested, we have a great interview on Halftime Talk this week with one of our regular commentators, Adi Imsirovic, who has just written a book about the deep insights of the oil markets and their structure and their history and their outlook. Really quite a useful 20 minutes to have a deeper understanding of where things are going. But thank you very much. Take care, everybody. Have a great day. We'll catch up with you in the coming days. All the best.
Thank you. Bye-bye.